Welcome to the Silent Trading channel. Today I'll be analyzing the gold chart on Wednesday the 7th of January. But before you watch, please subscribe, like, comment and share if you like this video. And if not, please comment on why you do not like this video, on what I can do to improve this video for you guys to see, for you guys to watch. And here I'll be starting on the 4-hour time frame today. So on the 4-hour time frame, as we can see that the 4-hour time frame has now changed trend to the downside, or what I'm calling is a price action to the sell side over here, with a body candle close below support and below wick, which is quite a strong price action to the sell side. But this isn't a strong price action to the sell side yet, because price action to each side, or a reversal to each side, will only be complete and strong after closing below key support. And key support is over here, which is also the reversal up. And the first candle wasn't able to close below key support, but the next candle was able to close below key support by retracing up, create a top wick, and pulling back and pushing down, and was able to push down and close below key support. So this candle closing below key support over here indicates the chart or the market is now attracting buyers into the market, which means by attracting buyers, the chart will have to dump the price further and further into leaving the buyers into an unprofitable position. Alright, so people buying on each and every support there is are now starting to go into drawdown. And the next candle after this closing below key support, this candle tries to go into a reversal but wasn't able to do so. Correct? Trying to reverse to the buy side but wasn't able to do so, because why? This green candle wasn't able to close above resistance, or wasn't able to close above resistance, or creating a reversal to the buy side. Because creating a reversal to buy side means that resistance must be broken. So by not breaking resistance, the price hasn't changed to the buy side yet. So when the price hasn't changed to the buy side yet, the next candle directly jump down and touch support, attracting more buyers, triggering more buy limits. You see here, support and resistance is where people place their buy and sell limits. Buy limits are placed on support and sell limits are placed on resistance, which means support and resistance are where most buy limits are placed. So by touching support, buy limits are triggered. By touching resistance, sell limits are triggered. But that will only be on some occasion that people do not just place sell limits on resistance or buy limits on support, but sometimes they place a buy stop on resistance by playing breakout candle. So they place what? They place buy stop on resistance. But most of the time, resistance is where sell limits are placed, and support is where buy limits are placed. So by pushing down and touching support, which means buy limits is triggered, so the price dumps down further to clear off buy volumes or buy position triggered from this support. Correct? And by pushing down like this, and if this candle is able to close below this support, which means price is likely to go down then up, or at least until the price starts to reverse or create a price action to the upside. So if this price is able to close below this support over here, and the next candle is able to push up and break this resistance, is what I call a key resistance. Why is it a key resistance? A key resistance is where reversal happens. So this is a key resistance. This is also another key resistance. And another kind of key support and resistance is where there are big candles flying up like this. You see this big body candle. This is what I also call a key support and resistance, because a big body candle indicates much position or much volume over here. So a big accumulation of volume in this kind of big candle indicates a key support and a key resistance. If it is a red candle down and a big one, that is also a key resistance. So this green candle over here can also be a key support at the candle open price, because this candle is such a big body candle close. So this is what I call key support and resistance. So there are first kind of support and resistance is key support and resistance is where reversal happens. So this is a reversal, which is what I call key support. But this reversal is created to trick people into buying rather than what? It's created to trick people into buying when the price push down and touching support. So buy limits will be triggered. People will start buying on this support and the price will start pushing down further. Why? The price push down further because people are buying, and the price need to push them down into drawdown for them to cut loss, for them to close their position, or at least for people trading on the Forex market, they will start to hedge by using sell position to hedge their buy position. Why do they need sell position to hedge their buy position if their drawdown is too much? Because by using sell position to hedge their buy position is by hedging their losses, is by locking their losses in a lock mode, by preventing more and more losses in the market. This is what people do on the Forex market, but in the future market there is no hedging. It is a perpetual trading. So the only thing buyers can do is to close position and to buy below, or either they can open more orders below and the price will gather a new entry price for their position down below, and for them to close at break even if their position is placed well. This is what futures trading is doing. But for Forex market trading, people most likely use sell position or sell orders to hedge buy position that are deeply in drawdown. So do you get what I'm saying? That in trading, we don't just trade the chart using candles, using patterns, using indicators. We trade a chart by understanding retail traders' psychology, and by understanding the psychology of retail traders, we understand where most of the traders are entering their position. We understand where most of the traders are placing the buy limits, and we know where to place our buy limits. We either buy before majority of the traders get their position, because price is likely to reverse before allowing retail traders to enter a position. So if price is going up further, price will push down, but never touching the support, because by touching support, which means buy limits from retail traders are triggered, which means retail traders are starting to buy at the support. So if price drop down and touch support, which means retail traders are entering a buy position, the price is more likely to go down further. So if we want to enter on a good price, we enter where retail traders are not getting their position, or we enter after retail traders get their position and the market drops down further, causing them to close their position, causing them to cut loss, causing them to liquidate, causing them to either open sell orders to hedge their buy orders. That is where we start to enter a buy position, because more buyers are getting into drawdown, which means price is likely to reverse after buyers are clear off from the market. Do you understand what I say? So when we enter a position, we enter based on retail traders' psychology. By understanding where most of the traders are placing their orders, we know that we do not place the orders where most of the traders are playing. We only play after most of the traders are clear off from the market, or we either buy before all traders gets their position, because price is likely to reverse before the other traders enters a position. So if price is pushing up, this candle retracement will retrace but not touching the support, and will start pushing up further. Why? Because by touching support, buy limits are triggered. Buyers or retail buyers are buying. So if retail traders are buying, the price is likely to push down further, not going up. So right now, as you can see, price dropping down and has already triggered buy limits over here. So when price triggered buy limit over here, you see that the price dumped down further, right? So this price dumping down is where the price is moving down to what? To sweep all stop loss from retail traders buying. So buy volumes or buy position from retail traders now has already triggered the stop loss, correct? So by triggering stop loss, price has two ways to go now. It's either pulling back up to go into the buy side, or to go into the uptrend, or either close below this support and continue to push down further. So why does it continue to push down further? Based on psychology, based on retail trader psychology, we do know that some people have big enough capital to what? To endure drawdown. No matter how deep the price is going, they are holding on to their position and waiting to enter a better position. So for these traders who are waiting, who are enduring the market process and waiting to enter a better position, which means the market will drag them into a drawdown further and further down. Alright? Why? Because they need to pressure these traders into cutting off their losses. Do you understand me? So when you know that these kind of traders are still holding on to their position, you do know that the price is going down further. So because if the market has less or little to none buyers right now, this candle will already have pulled back up and push up into a green candle, and will be able to close as a green candle. But if not, if this candle is closing as a red, which means the market is looking to drag more buyers into the drawdown position, which means market is likely to go down further. The market is likely to attract more buyers into the market by going down further. So why is it going down further and attracting more buyers into the market? Why? Because there are multiple support over here, which means as price is dropping down, support is where buy limits are triggered, is where buy limits are placed. So market pushing down, triggering all buy limits over here, triggering all buy limits over here. It's where buyers will get their position or their portfolio liquidate at which price. We do not know, but we do know that if the market is fully pressuring all buyers, the market will start pushing down further and further, attracting more and more buyers, accumulating more and more buy volumes. So when it has accumulated enough buy volume, the next thing the price has to do is, by doing this, sideways down, correct? Sideways down is slowly descending down, right? Sideways down, like this, sideways down. And when it has accumulated enough buyers in the market, and these buyers wouldn't cut loss and is still holding on to their position, the next thing the market has to do is to retrace and then dump down the price. Do you understand? So this is what I call a psychology trading. I don't trade only based on price action, or I don't trade based only on price action, but I also trade based on psychology, from understanding what retail traders are trading. And I do this by asking around. I do this by interviewing